Thank you for joining us for our Seaspray Making Waves podcast series. Brought to you by Seaspray Financial Services Limited and Seaspray Private Limited. Seaspray Financial Services Limited and Seaspray Private Limited, trading as Seaspray Private, are regulated by the Central Bank of Ireland. This is Seaspray Making Waves Podcast.
Hello again, and welcome back to episode 7 of the Seaspray Making Waves podcast series. Before we begin, a quick reminder that you can watch and listen to the podcast series on our social platforms, Spotify, Apple, and YouTube, as well as on our website. You can subscribe for free to our YouTube channel, Seaspray Making Waves, and follow us on our LinkedIn page for all the latest financial insights. Joining me for today's podcast are our regular contributors from Seaspray, Paul McGowan, Managing Director of Seaspray Financial, and Danny O'Leary, Head of Seaspray Private. Welcome, guys, and it's great to have you back.
Good to be back, Marty. Yeah.
Yes. Danny, it's fair to say that our Q1 outlook, which we discussed at the last podcast, it scored quite well. And those infamous 4 I's that we introduced that are still as relevant as we sit here today as they were back then. You know, so what's the outlook?
It certainly has. Our focus on the 4 I's, just inflation, interest rates, income earnings, and the investment ideas and themes that are out there. So maybe if I can just sort of scorecard, I think the critical thing, Marty, is that we started off Q1 on a bull run type scenario, and the markets have been sort of choppy in terms of Q2, April down, but May is up. And the May markets have actually, again, produced, strong returns. So we're actually looking at year to date where S&P up 15% plus, NASDAQ 17%, European and Irish markets anything between 7 and 9% year to date. So we're all in the green in relation to that. And I think from the scorecard, that's what we were looking at, that would maintain in the green as we go through the second quarter. So on the performance-wise, it's still strong. Bond markets, not so strong. It's probably just slightly -2. And again, I think that's a reflection on the fact that the anticipated rate cuts that we were looking at start of the year, that hasn't happened. So the market has had to digest where are the central banks moving and where they are. And this is something we'll probably touch on later, but there is a divergence now in terms of where do we see interest rates going. So on the interest rate front, Marty, we've had one cut from the ECB at 0.25. The markets would have been looking at the US to have done 2 or 3 at this stage, and even from a European perspective. And that's not going to happen. We said in our scorecard, it would be a second half of the year and gradual. And I think we're probably in and around that scenario, Paul.
It looks like the ECB are probably going to do another cut, maybe mid-September. And then the US, all the focus is in there on whether or not inflation is going to break through that 3.5, 4 to 3.6 level. It's very sticky where it's at the moment.
Yes.
The US economy is showing still very robust signs, strong employment levels. So all of those factors are pointing to higher for longer, and the market's pricing that in. But I think there's still an expectation now that it probably will cut. The first cut will come after the US election, not before it.
Yeah.
So mid-November, you could likely see a first cut. But there is a divergence at the moment between the different countries on that basis.
Yeah. Do you see that continuing, or will they reflect each other's policies going forward?
I think you're going to see a divergence. The good news on the inflation side, it is coming down, but we did say it was going to be sticky, and people are still feeling that. When you are purchasing, your coffees or whatever's out there, it's still expensive, and we're not taking that, in terms of anything other than inflation is still there, and it's still caused us problems. But the good thing is we've had employment.
Absolutely. Yeah. But just sorry for cutting across. But on the inflation side, like in absolute terms, US inflation is up nearly 21% from a standing start. So that's what the consumer is feeling. When we and people in the investment markets talk about inflation's coming down, it's the rate of growth and change that is coming down, not the absolute in amount. So costs of goods have all gone up across the board and are staying up.
Yeah.
It's just the rate of growth is slowing. So that is that's the big negative in the American economy. What is really driving the negative sentiment there, even though their absolute numbers are improving on the ground, but the consumer isn't feeling it is the issue.
And I think that's the key. And the critical thing is that's still going to filter through the second half of this year. But the good news in terms of, we've maintained all along that we believe that a soft landing in the United States will be the sort of outcome. We're still of that view, but you're still looking at a situation whereby interest rates and the Fed will not be reducing rates until they can see the inflation coming down to that 2.5 level. So probably agree with Paul, November, sort of time in terms of that. UK inflation is now down at 2%. So I'm probably looking at from a UK perspective that there could be a cut in terms of between now and September. I think anything that Christine Lagarde is saying on the EU front from ECB would be that it's data dependent is the key word, I think, coming from Europe. So the next cut, I think you're going to see a cut, which we've had, a pause, and possibly another cut. But that could be September. It could be even later on in the year. I firmly believe that's the right way to approach it, because you're then looking at moving into 2025. We've seen interest rates, Marty, go way up over the last 18 months. The cycle is downward, but I think that cycle will be a gradual downward based on data that's coming out. And I think that's important. So the critical thing on the 4 eyes is that if you're taking inflation and interest rates and we're now moving in that downward trajectory, I would see that as a positive for 2025 and beyond in terms of the markets. I think the other side of it, this sort of quarter, that we've seen the numbers coming from company earnings, income. And I have to say that when we look at the fundamentals, company earnings have actually been strong. In the United States, most of the companies have now reported that they beat expectations by about 78% of companies have beaten expectations. In Europe, 60% of companies have beaten expectations. Now that has actually supported the equity market. So within what I call the interest rates and the central bank and the divergence, company earnings have actually been a driver of markets.
It's fundamental
coming through.
And
of course, we've said this in the last couple of podcasts, the Magnificent Seven have been the key drivers. And in particular, one company, NVIDIA, and they've had stellar performance. But you're now seeing more of a divergence. I mean, Tesla has been negative so far this year. NVIDIA has been a stellar performer. And you have Microsoft, you have Apple, somewhere in between, and Meta coming in 25, 30% ahead. So there is a divergence even in terms of the performance of the Magnificent Seven. So I think what we're seeing is that, yes, there has been a very concentrated sort of performance, and that's driven earnings in terms of the US economy. But I think we're beginning to see a more broader spread coming out, and that has to be good. In terms of, the actual broader market.
Yeah, and the other thing that we have to just keep in mind, because what you're talking about is really positive news.
Yes.
So corporate earnings coming in so far ahead of expectations means that the multiples of the market are actually pulling into fair value again. So people who might think, oh God, markets have run too far, well, actually the corporate earnings are reflecting that. So the markets are not out of kilter on the broader basis. There are questions about some of the Magnificent Seven. Some of the analysts are struggling to figure out where are the earnings going to go. NVIDIA, which is now the biggest company effectively in the world, analysts are all trying to figure out how much more are they going to grow. And, so you're seeing divergence of forecasts from anything from share price of around 120 up to, I saw yesterday, one analyst coming out talking about 160. Now, these are huge spreads. And so the market will be digesting all of that. But that's all a positive. Interest rates coming down, expected over the next 6 months, that's a positive. So we're looking at a positive backdrop, strong earnings growth. You're looking at strong employment globally, really. Like if you look in the US, really strong employment. Ireland, really strong. Europe has picked up strongly. So all of the backdrops are positive, and you have the likelihood of recession now disappearing into the background. The only issue, as we had, and I remember we had this discussion at the beginning of the year, at the end of the first quarter, is the geopolitical risk. Yeah. And geopolitical risk still exists. And we still have the Gaza issue. We still have the issue in Ukraine. None of that has gone away. And you do have issues within the China Sea as well, and concerns about Taiwan. So those things, if they blew up further, could destabilize. But the overall economic backdrop is very positive.
Right, okay. And just on touching on the equities again, I mean, they've set some record numbers since the start of the year. I mean, what has driven that? And is that likely to continue, or are there headwinds that we need to be conscious of?
The headwinds will always be the geopolitical issues out there, but they're there throughout history, and I keep coming back to this point. If you go back through the equity performances over the past, 60, 70, 80 years, they've come through wars, they've come through lots. They will move on through that. I think what we're looking at more is, what are the fundamentals? What is the backdrop to the inflation story? What's the backdrop to the interest rates? And I agree with Paul. I do believe that's supportive for the markets going forward. So if you were saying to me, markets up 15% in the US, would you take that for the full year? I would take that for the full year, So I think we've got to be realistic as well. There is uncertainty, but there is strong support that markets will move through that over the coming 6 months. We've got elections. We've got the UK election. We've got, US election, possibly an Irish election. So they're all happening. But I think the markets, and we've seen this in history, over 50 years, in terms of, if I take the Euro Stoxx 50, they've looked through all of the elections that I can look at in terms of that period of time. The market's done about 12% per annum through those years. So I do believe that would be looked through as part of the next 6, 9, 12 months, Marty, in terms of performance. But again, we're looking at strong performance year to date. If we can hold that, I think we'd be very happy to hold that as part of the gains for the year.
Yeah. I think we've had some relevant video insights. I think that people can view on our website there. So,
yes, absolutely.
There's one recent one which I refer our listeners to. Taking stock of the best performing stocks so far this year.
When you're looking at it, that insight is a super one, because it's showing the top 5 companies in the United States, it's showing Europe, and it'll give viewers a good idea of the spread that's coming out there. It's not just the Magnificent Seven. You are getting energy companies, you're getting banks in there, you're getting, resource like SAP and Safran in terms of France, in terms of the aerospace. Rolls-Royce has been performing well. So there are a number of companies that, you can look at to say there's a widening of the base as well. But back to what Paul said, our focus, certainly in terms of new solutions, we see Europe as being still very good from a valuation perspective. They're trading on 14, 15 times earnings, which is below the long-term average. If you're looking at lower interest rates, which we believe will happen, if you're looking at inflation moving back to 2% target levels, which I believe we are, that has to be supportive for cyclical stocks, which I'm looking at from Europe, and they will form part of the themes that we will be looking at for 2025 and 2026.
So value in Europe, Danny, is you say so.
And again, from the wider US market, we're concentrating on the Magnificent Seven. There are a lot of good companies in the 493 other companies that are there. And they have not been booming like the Magnificent Seven. So across sectors, we do see that there is going to be value in the market over the next couple of years.
Yeah, and I think just on that point, Paul, if we could just bring it back closer to home, the ISEC has turned up some really top performing stocks so far this year, but is that reflective of the wider Irish economy?
Yeah, well, I think we need to look at Ireland. Like, if you want to look at Ireland Inc., there's some very interesting things coming out in Ireland. Firstly, we have 155 billion as of this morning on deposit from households. Highest level ever. If you compare that against at the end of COVID, we had 120 billion. That's when households weren't spending, people were locked up. we've now opened up, the economy's been growing, and you would have expected the consumer has been spending, and yet the level of savings has outperformed the level of spending. The second thing is we've got 2.7 million people employed in the country, which is the highest level ever in the history of the state. We have rising earnings. And we also have, when you look at the Irish economy against other economies around the world, the GDP per capita in Ireland now is one of the highest in the world at 157,000 per person. When you look at the US, it's just over 100,000. The UK and Europe are around 68, 69,000. So our economy is actually generating vast amounts of money, and where it's ending up is on deposit. Now, that money is available for investment. And it's the one thing there is still, across Europe, we have the highest amount of money sitting in overnight deposits,
right,
which is actually a bit crazy. Now, from our point of view, we are constantly talking to clients about the fact that if you want to stay in cash or near cash equivalents, there are options. There are government bonds, and there are also shorter term treasuries in Europe. So you can buy German treasuries, you can buy French treasuries, which are all priced off the current ECB interest rate. You can buy 1 month, 3 months, 6 months. You can buy in any size, and you can enhance your return. Instead of getting maybe 0.5% on deposit in your local bank, you can get up to 3.5% on treasuries. And that's something that we can do for clients. And a lot of people don't realize that. And it's really easy to do. It's safe because they're the bonds issued by the government. So if you're prepared to hold your money on deposit in a bank, you're taking the bank's risk. If you buy the state risk, it's even better for you. So there's great options to people in terms of doing that as well, which is interesting.
Absolutely. I think the critical thing here is that there are opportunities for investors. I think we've been very laid back in relation to proactivity in terms of it's been left there doing nothing for many. So I think there are opportunities to have good conversations in relation to what do you need short term, what do you need later on, etc. And those are the conversations I think that people will open up to as we're moving through 2024, 25, 26. So I think there's certainly from an Irish economy perspective, I do believe we'll have growth this year, and I do believe that the consumer, even though it's hurting with inflation, there's good employment, and I think we can bring that through in terms of the savings that are out there to support.
And the Irish economy, we have a couple of interesting things going on. Possibly the youngest Minister of Finance just been appointed, so it'll be very interesting to see what happens there. We're going to have a budget in October, so with a very strong backdrop in terms of tax receipts, the numbers just keep rising, and so the Irish government are going to be in a position to continue to invest in the economy and put money aside to save things. So against that backdrop, Irish corporates should be performing well in terms of the listed companies. What's interesting is we have a range of companies that are outperforming. They've been up almost 30% year to date. The likes of AIB, you have Irish Continental Group, you have Glanbia. The biggest companies have actually underperformed. So Ryanair, which was, is one of our stock picks, had a big pullback end of May into June, sitting around 16.50, 16.60 at the moment. We'd have a price target long term of 22, 23 on it. So this is a good buying opportunity. When you get these moments when things pull back. Also Kingspan, which is up 34% year to date, we still like that stock and would go for it. Kerry Group, very surprising, off 13% year to date. So it opens up opportunities. Now, they're some of the biggest stocks. So because the biggest by market cap are underperforming in the last month, the Isaac in year to date is only up 8%, whereas in reality, if we'd looked at the beginning of May, it would have been up nearly 30%. So opportunities open up within the economy and within the markets to buy stocks at the moment.
Excellent point there, Paul.
And there's money actually just even in the last few days announced 300 million to help in the decarbonisation of a lot of companies into that. So I think there is money. I think it's being focused, and it's coming back to my hobby. It's about recycling. It's about everything to do with the planet. So from an Irish perspective, I think we have to highlight 35% of our electricity in the first 5 months of this year has come from wind. I think that's a phenomenal achievement. So a third of it, and we're moving in the right direction. But if you remember our first podcast of the year, I mentioned the deposit return
I remember
scheme.
it well, yeah.
Yes.
And I know there was people who were doubters and will it work or will it not. Just to give a couple of numbers, there are 200 million cans and bottles recycled so far since February. 2.9 million cans and bottles are being recycled every single day. And that is a phenomenal achievement in terms of where we come from, in terms of that. And one really good story, very quickly, Marty, was down in Cork University Hospital. 3 porters got together to have points where you could drop the bottles in from patients, staff, consultants, everyone. And within the first 2 months, they have raised €3,000 for charity from the collection of those bottles. And you have those initiatives happening all around the country. So I think, number one, my hat goes tip to everyone doing that. And I think it's a super sort of recycling initiative. And I think that will grow as we are going through in terms of that.
For sure. I think as a nation, I think we're buying into the sustainability agenda for sure. Definitely.
It is huge. And it's part of our growth theme as well.
Exactly. Just bring it back. You mentioned having conversations with clients earlier, Danny. I mean, you've had some very positive ones recently with the successful maturities of our structured solutions. So given your experience with that, can you identify for us some of the key growth themes going forward?
It's again, with the movement of the markets over the last 6 months, it's allowed us from some of the structured products that we would have. We've probably had about 10 maturities since the start of the year, which has been very strong for our clients and for us. They have ranged from the circular economy. They have been tech, the tech story. We've had artificial intelligence, and I keep coming back to this theme on the basis that people believe artificial intelligence, it's just tech. Artificial intelligence transcends sectors across the globe. It's healthcare, it's tech, it's your manufacturing. It is going to be invasive across all of sectors, and that's why I believe that AI is our new internet. I keep saying this. So I do believe that there's a strong growth theme, still very strong in terms of the wider AI scenario. But we've had returns coming from our climate change structured products. And again, just to reflect back, some of these are maturing on the basis that the markets have not really moved. That 2 or 3 years ago, we were looking at where the level of the market was. They're coming out at where virtually the market has been on a sort of a level footing over that period, but it's been able to translate that into a return for our clients. And again, I think that's a feature that we will continue to develop and continue to move on. So currently, we're looking at Europe. I mentioned that earlier on. We do think there's value in terms of Europe, particularly on the ESG side and our focus on that. I think on the tech side, I do believe while it's going well, there are still very strong opportunities. There's opportunities on the healthcare side. So we will be bringing out various new solutions that would be reflective of those type of growth themes that we're looking at, Artie.
Great, excellent. And it's you made the point, the AI story, it does permeate lots of other industries. I mean, there are complementary industries that are benefiting from that boom,
When you look at you step out into your car, every single thing that's happening on there now is AI generated. I mean, it's just phenomenal where everything is moving in terms of that, be it education, be it healthcare, robotics, manufacturing. It is coming across all areas. And the companies that are driving that in terms of the semiconductor market, the NVIDIAs, and the ASMLs of this world, they are going to be, this is the reason why we believe that they will be continuing to move in the positive direction that they are over the next 2 or 3 years.
Thanks, Danny. We've reached that point, guys, where we have a couple of questions for you. Okay. So Paul, come to you first. This is a question from an investor. I'm a more traditional investor with a balanced outlook. Should I jump on the current tech and AI boom or stay diversified?
Well, firstly, if you're a medium risk investor, you need to have your portfolio reflecting that. So yes, definitely have some of the traditional, more conservative investments everything from bonds through treasuries into lower risk funds. But you have to have some exposure to where the growth areas are going to be. And there's no two ways about it. AI is the big growth area. As Danny was just talking about, it's moving into everything. And you don't just have to go down the microchip route like NVIDIA's and ASML. You can also go to the sectors that support those. So some of the cloud, there are companies specializing in data centers, in cloud support systems. And we have a range of those sort of stocks that we are starting to build into portfolios for clients. And it's easy to get a basket. Always do diversification and have a basket of things like that. That will then provide support into your portfolio that will give it the kick. At the end of the day, we tend to target our clients we're looking 5-10 years investment down the road. The classic rule of 72, if we can get you 7% per annum, you'll double your money in 10 years, which is a very comfortable place to be. And you can have that within a portfolio that's still a low to medium risk portfolio and have a little bit of the emerging areas in a portfolio. They must reflect it.
Great advice, Paul. Great advice.
Just to follow on from that, in constructing a portfolio, you can have balanced, but you can have mixes of some in the lower risk area and you can have some in the medium risk, but you can also have what I call the satellite opportunities, where you can actually look at growth and look at the areas that may be AI or growth rated. So you can balance that out so you can still be a balanced type investor. But that doesn't mean to say that you're missing out in terms of any part of the market, because we can diversify portfolios and construct portfolios to take all of that into account.
And it reflects the risk tolerance of the client,
100%.
So Danny, you're not getting away lightly here. I've got a nice, easy one for you. Are the recent China-US import tariffs a concern for global growth, or are there just isolated incidents like the electric vehicle tariffs?
I suppose any time that you're looking at tariffs, it's not helpful. That's as simple as that. I think what we're seeing is that tit for tat, and that goes on all the time. We've been seeing that even over the last 10 years, and in terms between US, China, and US or EU and China, etc. I think with the Ukraine war and what we've seen in terms of supply chain scenario, you are tending to see from a US manufacturing from the within rather than being dependent on China so much, etc. And likewise from the EU. So I think there's going to be a rebalancing in relation to that. I think it will be confined to particular sectors, possibly in terms of the semiconductor or the EV market. But I do think that what we've come through in terms of the overall supply chain crisis that we've had from the war far outweighs what I would be seeing in terms of the tariff and the tit for tat that's moving. China needs to grow, so it's still going to be very much focused on trying to be, get the goods out to market as well as the domestic economy. So, will it have an impact? I do believe, it will have a certain impact, but I'd be more positive in terms of the wider fact that you now have economies that are trying to move out of the Ukraine situation, and the geopolitical side of it has been probably the main negative.
In fact, Danny, it's very interesting. It's putting a focus, if you want to look at emerging markets, at the moment, the leading market to look at is actually India, which is now the largest economy, and the biggest by population. And people are starting to refocus. It doesn't have any of the tariff issues. It doesn't have a lot of the issues that are linked with. It's not going to war, concerns about that. So if people are interested, it's worth having a look at the Indian market at this point in time if you're looking, to avoid some of the issues that are going on with China.
Good point, Paul. Excellent insight, guys. I'd love to keep it rolling, but unfortunately, we've reached the end of the road yet again. So can I thank you both for your wonderful commentary. Thanks. Very useful insight. Thank you.
Thanks.
To read more detail on today's discussion, I can refer you to our Q2 Investment Review and Outlook document, which is available now on our website, along with our suite of market updates and our video insights. You can also follow our content on our LinkedIn page. And just a final reminder that this podcast and the series is available on Spotify, Apple, and YouTube, where you can subscribe for free to our dedicated YouTube channel. So that's it for today. Thanks very much for watching, and we'll see you next time. Bye for now.
The preceding content is informational only and based on information available when created. It is not an offer or a solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you. Seaspray Financial Services Limited and Seaspray Private Limited, trading as Seaspray Private, is regulated by the Central Bank of Ireland. Thank you.